Equity Mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. My name is Bryce, and as always, I am joined by my equity buddy, Ren. How are you going?
I'm good, Bryce. I am very excited for today's episode. We have a lot to talk about. We're talking tech stocks, we're talking crypto, we're talking SPACs, we're talking all of the super hyped asset classes of 2021.
That's it. So much to get through. So just a reminder before we get started, Ren, that the Equity Mates Awards are still open. We're still looking for nominations. This is the last few days that nominations will be open. And we're giving the Equity Mates community the opportunity to call out, highlight, reward some of the best experts and CEOs and community members from 2021. So there will be a link in our show notes. There's a link on our Instagram page as well to submit your nominations. We're looking for Expert of the Year based on content that any of our podcasts in the network have done. We're looking for CEO Business Leader of the Year based on any of the podcasts' content. We're looking for Community Member of the Year, those that have really added value and demonstrated the Equity Mates spirit in our community groups. And we're also looking for ETF of the Year and for Platform of the Year. So there's been plenty of nominations coming in. We're sifting through all of them at the moment, and it's great to walk down memory lane with some of the amazing stuff that has happened this year. Finalists will be announced later this week for next week, and then we're going to be doing an awards ceremony of the week commencing 13th of December. We're really excited for it, so please do share with us your thoughts on those topics.
One more piece of housekeeping very quickly. If you didn't see our stories, we want to sponsor your local sports team.
Social sports team.
The team, we're all for the retail investor here. And similarly, we're for the retail sports player. That no other sponsor will go near. We want to shout you guys some jerseys and cover. We want to shout you guys some jerseys and cover your rejos. So head to our Instagram stories and check it out there. Yeah,
there's a form for you to submit. We want to help you and your teammates kick some real and investing goals. So, we're looking for some amazing social teams to sponsor. But Ren, let's kick into it. 5 topics to get through today. And let's start with the growth stocks because if you're in an index, if you're in the NASDAQ index, you might be somewhat fooled by what's actually going on in the growth stock landscape.
Yeah, a bubble has burst.
Yeah.
And just no one is really noticing it because the index is just driven by the FANG, or the Fan Mag stocks.
Yeah.
But I'm going to say Fan Mag plus TN.
Tesla, Netflix.
No,
Tesla, Nvidia.
Nvidia is now an $800 billion company, and it's
had a phenomenal
year.
Phenomenal year.
So if you look at the chart of the NASDAQ 100, it's been a great 2021. You have gone up almost 30%, 29% year to date. Like, that is a cracking year. That is a year that is unlikely to be repeated. But look under the hood, and tech stocks are getting pummeled at the moment.
Yeah, they are.
Let's just talk about, so from all-time highs, just some of the notable names. Peloton, down 75%.
Slammed.
You're going to have to say slammed a lot here. Zoom, down 60%. Square, down almost 30%. Spotify, down almost 30%. Shopify, down 12%. Twilio, down over 40%.
Oof.
Teladoc, down 66%. Roku, down 45%. Coinbase, down 27%. Did I say Uber already?
You didn't, but you can say it.
Okay, Uber, I've got it down 16%, but I was looking at it earlier. I'm actually pretty sure it's down more than that. Uber, down 33%. Tech stocks are getting slammed.
Tech stocks are getting slammed, and if you're holding any of Cathie Wood's in ETFs, her ARK is the primary one. ARKK is the ticker. Of those stocks that you read out, Ren, I think almost all of them are top holdings, you'd be in a world of trouble. It's really interesting. A lot of those companies, Roku, Coinbase, Square, Spotify, Twilio, have all been spoken about on the show by, a lot of our growth fund managers who have come on. So I wonder what they're feeling about it. Are they taking this opportunity to buy into the stock? Is it? I'm sure it's not changing their thesis on the stock, but it'd be interesting to know what their approach is here.
Yeah, and I think the important thing is it's not just unprofitable tech stocks. Like, a lot of it is unprofitable tech stocks, but PayPal down 40%.
Bang.
Yeah, bang.
Yeah.
So I imagine they would be pretty disappointed, the growth managers. Yeah, but
Their performances, yeah.
And I was trying to find a NASDAQ 100 chart and then a NASDAQ 100 chart X those FanMag plus TN that are on the NASDAQ. Some are obviously listed on the New York Stock Exchange. I couldn't find it, but I think that would be a pretty telling chart because it feels like it's a tale of two markets in the tech world at the moment. There's sort of 8 companies that can't put a foot wrong, and then there's everyone else.
Yeah. In some ways, there's a bit of a defense. Yeah, being in these indexes, like as you said, these companies have been absolutely pumped, but due to the weighting of these top 8 companies, you're really barely feeling it in some instances, and it's obviously showing that the market believe that the valuations and future prospects of these top 8 are much more realistic than the valuations that the market were putting on a lot of these sort of second-tier tech companies, the Pelotons, the Zooms, the Etsy's, the Pinterests, all these...
Etsy's up.
Etsy's up?
Yeah.
Is it?
Yeah.
So, yeah, I mean, there's plenty of...
Also, Coinbase has come back incredibly strongly. It was down, but crypto, baby. Crypto's undefeated.
Well, we are going to talk about crypto a bit later on.
So I found a tweet from earlier this year that sort of sums up some of these companies and just how different 2020 and 2021 has been. Now, this was from May 2021.
Right.
So the 2021 returns have obviously changed. But it tells the story. It tells the story enough that I didn't want to do my own research and get year-to-date returns.
So do not try this at home.
All right, 2020, Tesla up 743%. 2021, down 18%. I think that's changed. But Peloton, 2020, up 434%. 2021, down 39%. Now down 75%.
Yeah.
Zoom, 2020, 396% up. 2021, 10% down. Square, up 250% in 2020, down 8%, but more than that, now down 30% in 2021. So a lot of these companies are companies that have had incredible 2020s. They did very well during the pandemic, but God, it is a sea of red out there.
So the thing is, even if you buy the index now, even if you look at this and go, okay, great, all these amazing companies, well, all these companies, up to you if you think they're amazing or not, have taken pretty hefty haircuts. If you were to anticipate that over time they do get back to their all-time highs, you're looking at some pretty significant growth from where a lot of these companies are now.
Yeah.
However, if
a company falls 50%, they have to go up 100%.
Yeah. So if you then take the approach, all right, well, I'm going to buy into the index to realize this growth over a period of time, it doesn't feel like that's the right approach because you're going to need the top 8 companies to also pump out significant growth to even feel some of this bottom end stuff. Does that make sense? Like buying into the NASDAQ 100 because of the top weighting, even if Pinterest goes up 100%, even if Zoom hits 100%, if you're in the NASDAQ 100, you're barely going to feel it.
Well, yeah.
Yeah.
But that's not new news.
I know.
That was the same in like 1990.
Yeah, but I'm just trying to spell it out for someone at home who might see this as being, okay, well, now's the time to buy NDQ. You're not. What you're really buying into is 70% weighting of the top 8 companies.
Well, I don't think it's quite 70%, but
It's
God,
a
it
lot.
might get there. Yeah. Like, it's basically just a super concentrated big tech ETF now.
Yeah.
But hey, if That's
tech,
not
baby.
that hasn't been a bad bet.
Exactly, it hasn't been a bad bet.
And the just unbelievable thing is that the returns that these big companies are getting just doesn't seem to slow down.
No.
Yeah.
Yeah. Well, that's what I mean. I think the market's obviously looking at these top 8 and going, they're there for a reason. People can still justify it. Feels like a lot of experts we talk to can justify the multiples that these companies are pumping out and their future prospects.
Yeah, well, I mean, like some of the multiples aren't even that crazy. Microsoft is trading on a 37 PE.
Yeah. Okay.
Like,
it's not nuts.
It's just the fact that they're $2.5 trillion, but like 37 is pretty
$2.5 trillion.
pretty okay. Yeah,
It's crazy. So yeah, interesting what's going on. I'm sure a lot of people in the community who are in the ARC and those sorts of things might be hurting a little, but yeah, pretty fascinating to see the dominance of these top 8.
yeah. So in case you missed it, there is a bubble bursting. It might feel like nothing can ever go down, but I think the headline is these second tier tech plays, and second tier isn't meant to be derogatory. It is just if you're not Apple, Microsoft,
Yeah.
or
We don't have time for you.
yeah. Well, no, I actually have a lot of time for you, but you are second tier.
Yeah.
There's a bubble bursting. I guess the question is, why is the bubble bursting?
Valuations.
Inflation,
Yeah.
risk of interest rates, all of that stuff. Like, this is how the market is supposed to function when inflation concerns are high. People worry that interest rates will go up. They worry that will affect growth stocks, that especially unprofitable growth stocks that need to borrow money, and they reduce their valuation. And also, if we're getting very technical, the discount rate in a DCF will go up if interest rates go up, because the risk-free rate is going up, and relative returns in the bond market are changing. And that will drag down the present value of future earnings for tech companies. So this is how the market is meant to function. When interest rates go up, high-flying, unprofitable tech companies should come off. It's just the speed and the extent to which they've come off, it's surprising. Like Peloton being off 75% hurts. But in some ways, it reassures me that not everything goes up all the time.
Well, yes.
Because we're about to talk about crypto.
Well, yeah, let's do it. Let's keep moving. So we spoke about last week, on last Monday's chat, we did a bit of a deep dive, or an introductory deep dive on Web3, and tried to get our head around what's going on. And
Well, no, the episode was you convincing me about Web3, and you obviously did a pretty good job, because in the last week we're now in Web3. We're now officially
in Web3, baby.
We're now officially members of a DAO.
a DAO. And if you haven't, if you have joined us for the first time, welcome to Equity Mates. It's great to have you on board. For the next 5 minutes, you might have no idea what we're talking about, so go back and listen to the Web3 episode on Monday, because yes, Ren, we are now officially part of the Web3 community. We are in a DAO, a decentralized autonomous organization, and God, it was tough to get in.
In the last episode, I was talking about how Web3 is going to be incredibly technical, and I think there will be a Web4 that makes it easier for mums and dads to participate. The last week has only convinced me more that is the case.
God, it was crazy.
To get into this DAO, which we heard about from someone we were speaking to, called Klima.
Yeah, let's pause there. So Klima is essentially a DAO that is, they say they're driving climate action by essentially buying carbon credits. The idea that they have is to buy as a serious amount of carbon credits over a period of time, to the point where they have so many that they will force companies to buy credits off them to offset, and the price of their credits are going to be more expensive than markets. Now, plenty going on there. We kind of just got into it because we wanted to get into a DAO, and we thought this seems reasonable.
I like the idea of increasing the cost of polluting.
Yeah.
Like, if companies have to buy credits, and these guys are adding buying pressure to that market, I like that idea.
Yeah.
But I also like the fact that it was paying 38,000% interest.
Yeah, so there's a thing called an APY, annual payment yield, or something like that, and it currently is paying 39,196. It's stupid. Anyway, So we got in.
It basically means you're doubling your money every day.
Well, that's what they say, but then in the fine print, I think it's 8% for a 5-day ROI. So we're in. And
You only earn 8% a week.
I know. I think it's 1.5% every 8 hours or something. Anyway, we'll come back next week with an update on actually did that transpire.
It's going to get arbitraged away so quickly. Mark Cuban was tweeting about it.
Yeah, but the API's gone up since he started. So
APY.
APY. Yeah. Anyway, it was incredibly difficult to get in. I think that's the main thing that I want to call out. The process to get into this DAO involved, I think, 4 different crypto platforms.
Yeah, and we got
5 different coins.
Yeah, and some of those platforms like stopped us sending it to other platforms. So much for being
Wallet
like decentralized and no authorities.
I know.
I felt like I was trying to transfer money out of a bank. The amount of hoops I had to jump through.
It's crazy. Anyway, so we've learnt in the last week about the idea of staking. We've essentially staked our coins into Klima, and we're making a return on those coins. And it was. Yeah, if only we could show you. We might put a screenshot.
Well, I mean, we can talk about how we did it. We had to buy 1 coin on an exchange, so your independent reserve or a SwiftX or anything like that, and that was what was it? Matic? Polygon. Yeah, never heard of it before. And then we had to send that to a MetaMask wallet, and then we had to plug that into SushiSwap and God, I can't remember this, and transfer it to Klima. And then we had to transfer. To transfer that back to our MetaMask wallet.
No, then Klima sat in MetaMask.
Okay, and then we had to transfer the Klima to. No, then we had to go to the Klima website and stake it.
No, and then no, there was then you transfer it onto the Klima website. Okay. Yeah, then you stake it. And then you sit back and relax.
Yeah. So that whole process was a real learning experience for us. And I think that's the main thing. We're going to keep dabbling and try and figure it out because the technology is really interesting.
Yeah.
But if you were lost in that explanation, trust us, we were lost in the doing as well.
Crazy. So we'll try and keep everyone posted.
And obviously it's not a buy, hold or sell recommendation.
No.
Anything we talk about in this space is us figuring it out.
This is about our learning journey, and we're currently trying to learn and get our heads around what's going on. But on the crypto theme, Ren, look, one of the most renowned stadiums in Los Angeles, it's the home to the LA Lakers, has gone through a name change.
Yeah, people probably saw this news story that the Staples Center where the Lakers play, the LA Kings play in the ice hockey, is being renamed Crypto.com Stadium.
Crypto.com Arena, I think, is the official.
Okay.
Yeah. So you're right. It was the Staples Center from 1999 when it was first built.
Yeah.
And they took out a long-term lease, and it's a $700 million deal to Crypto.com.
20 years, is that right?
20-year deal.
I read that?
Yeah. 20-year deal to rename the stadium Crypto.com Arena. Crypto.com, for those who are unaware, is, I think, the 10th largest exchange. It's a Singapore-based company.
Yeah.
A massive marketing play from them. The company that owns Crypto.com Arena said that they have done this because they felt that Staples was now a bit of out of touch with their with the way that they want the stadium to be perceived and the new target market and all this sort of jazz. So I think they actually bought out the rights of Staples so that Crypto.com could come in. But you have other thoughts on this?
No, I don't. I mean, I have thoughts. And the key thing, like instantly when I heard this, the first thing that I thought about was it is an exact echo of the peak of the tech bubble. So let me ask you some stadium names and you tell me if you've ever heard of them. Network Associates Stadium.
No.
CMGI Stadium.
No.
PSI Net Stadium.
No.
Have you heard of any of the companies that underlie that?
No.
Yeah, because what happened in 1999 and early 2000 is a bunch of tech companies that had really expensive share prices and big balance sheets as a result went on a stadium sponsoring blitz. And then within like a year or two, they were all bankrupt. And the biggest echo is, so the Baltimore Ravens, the NFL team, they signed a 20-year, well, their stadium signed a 20-year deal, PSI Net Stadium, 20-year deal. The stadium came down 2002.
Like they bulldozed it.
No. They took the sign down.
Right.
It's now called M&T Bank Stadium. Banks a lot safer. But it's just like history may not repeat, but it rhymes, and in this instance, it is rhyming. 20 years of it just feels peak bubble.
Yeah, you are very feeling peak bubble at the moment across a lot of things.
I'm nervous. But
I'm not so peak bubble with the crypto space, I don't think. I think they just have so much cash.
That's exactly what you could have said about the unprofitable tech companies.
Yeah. But they're profitable.
Crypto.com.
These guys, yeah.
Yeah, but I guess if everything... Well, so here's the interesting thing about Crypto.com. They have a coin, they have a token, and so it's a $700 million 20-year deal.
Yeah.
I think the market cap of their token went from 9 billion to 18 billion because of that deal.
Wow.
Because of the press and PR around that deal.
Wow.
So in theory, it's a 20-year, $700 million commitment, and then they've just created $9 billion worth of value.
Yeah.
Obviously, they don't own all their coins, but still, it's an interesting one.
Smart play.
Yeah. But everything feels good when the rising tide is lifting all boats. It feels like everyone has a lot of money. But if all of these coins start tanking...
What were your thoughts
then it won't feel like they've got a lot of money.
Yeah. What were your thoughts around when Marvel renamed the Telstra Dome down in peak streaming?
Peak bubble in the Marvel super cinematic universe, and what's happened since then?
The movies have turned to shit.
Movies aren't as good. My Marvel obsessed housemate came home from seeing the most recent one and said it was the worst one he'd ever seen.
Well, yeah, which one was anyway? Let's keep moving.
No, well, okay, yeah. So for me, it's obviously it might not be peak bubble, but be aware that this was a key indicator of peak bubble. These businesses doing big splashy things with their balance sheet.
All right, so Ren, how are you approaching this time? You're in a bit of bubble mania, bubble fog at the moment.
So for me, I think there's so much really exciting technology being developed at the moment, and the commercial models around it are being figured out. And it feels very similar to 2000, where a lot of the theses were right at the time. It was just too early. If you've read The Hard Thing About Hard Things by Ben Horowitz, he was the CEO of a cloud computing company in 2001. Which cloud computing 20 years later is massive, industry standard and huge. But it was just 15 years too early, and the company, it got acquired, but it didn't live up to its potential. I look at the world today, Web3, NFTs, blockchain, dApps, all of that, and think we're in a similar moment, that the promise and the potential of it is so much, but with that comes that bubble mania. And there's this mental model that we've spoken about on the show before, but I want to talk about again because I think it's a really useful one when thinking about a time like this. It was introduced in a book, Technological Revolutions in Financial Capital by Carlota Perez, and it talks about, it looks at bubbles throughout history, or technological revolutions throughout history, and how financial markets react. And it normally moves in two phases. The first phase is there's a new technology. It's super exciting. Financial capital flows into the area because there's all this promise. All these new companies are started, and there's a lot of euphoria in the market, and it leads to a bubble. That bubble bursts, and then we get to the deployment phase after that, where the real companies emerge and the real business models are established. And that we all know that happened with tech. 2000 was the bubble bursting, and then out of that came those real business models in the Apple, the Amazon, all of that stuff. But in this book, it's the same with a bunch of bubbles throughout history. If you look back at when cars were first invented, it wasn't just General Motors and Ford that were established. There was similarly a whole bunch of car makers that were created, a whole bunch of financial capital flooded into the space. There was a bubble, it burst, and those long-term businesses emerged out of it. And for me, that mental model makes a lot of sense here. there are some brilliant companies being created today. The question is which ones of those will, which are those, and which are the ones that, which are the pets.com of this era.
And you're talking specifically about crypto.
Yeah, crypto, Web3, like everything that's basically been enabled by blockchain, I think. I think that the underlying technology is blockchain, and more it seems like it's the Ethereum general blockchain and other general blockchains. And then everything that is getting built on top of that, Web3, dApps, all that stuff, NFTs, all of that. It's, for me, part of me gets excited that it might be a bubble, because if the bubble bursts, that's the opportunity for investors. That's the buying Amazon in 2002 opportunity.
Yeah, well, I guess where do you draw the line? What's the crypto bubble of 2017?
Yeah, great question. But I mean, it's not like there's just one bubble. Like, the internet, we all think about the one bubble being 1999, 2000, bursting in 2001. But there were other booms and busts before that. Yeah.
I feel like it's just a rolling thing.
You think we're just going to keep...
No, like you go... It's like it's not like everything aligns perfectly. So like you might have all these small bubbles that are occurring within the crypto space, like the Web3 versus like actual, other crypto versus what's going on in metaverse versus what's going on just in tech generally. Just, you know what I mean? Like it's all kind of just a rolling. It's not like all of a sudden there's going to be this big bang, everything drops, and then from there it's smooth sailing. Do you know what I mean?
Yeah.
Because I like to look at what happened to Bitcoin in 2017, massive run up. But then that gave rise to like the altcoin sort of vibe. Like it wasn't all like 2017 wasn't it wasn't as prolific as it is now in terms of the amount of coins that are around and these DAOs and all that sort of jazz. And so figuring out where you are in that circle, I think is specific to what you're looking at. Do you know what I mean?
I know what you mean, but I think that might just be because we haven't had it yet. Like, I think if we put ourselves back in like 97, 98, we probably would have felt the same thing. Like, different parts of the tech ecosystem are up or down, and nothing's ever linear. But then you get hit by the big one, and then you know that's the big one.
I guess so, yeah.
Probably the same in like residential, in like the housing market.
That'll never happen.
Leading up, no, in the US, like. Some parts of the market probably went early. Like Florida was probably more over leveraged than other parts, and then it all collapsed in like the end of 2007. I feel like we have just lived this life as investors where we haven't really been hit by a big one.
Yeah, I think that model doesn't really apply to the stock market right now, though, right? Like you're talking about the adoption of the technology.
Yeah. I feel like if there's one thing to do at a time like this is read that book.
Yeah.
And also learn to code in Ethereum coding language. But yeah, for me, that's a really useful mental model that I think it's worth people understanding.
Yeah.
Yeah.
So that is Carlotta Perez for anyone who wants to do a bit more research on that. Go and check it out. We will include, I think it's on our book resources page on our website. If it's not, we'll make sure that we get that uploaded so you can go and buy that. But let's close out, Ren. We can't go too long without speaking about SPACs, and there's another SPAC deal that's hit the market. One that I don't think is too interesting. One that you were more surprised at.
Well, I made a meme about it and sent it to our work group, and I was like, "How crazy is this?" And you were like, "It's not that crazy at all." So I figure we should talk about it because we obviously have different views on it. Although, in chatting before we went live, maybe you've convinced me that it's not that crazy.
Well, put some context to it all. Manscape have revealed that they are going to be going public through a SPAC. For those that are unaware of Manscaped, it's a business that is prolific in marketing.
If you're not aware of Manscaped, you're not listening to enough podcasts.
American podcasts, particularly, yes. They're a company that specialize in men's grooming, particularly focusing on the pubic region. And they are going public.
They are via a SPAC.
Via a SPAC.
Yeah.
They are making money. They're pumping out about $250 million in revenue at the moment.
Yeah, that blows my mind.
Yeah.
So a few things blow my mind. First of all, they were founded in 2016.
Yeah, it's been an incredible growth story.
Yeah. Secondly, they specialize in shaving one part of your body.
Yeah.
But like, it feels so niche. It
feels niche, but yeah.
But then the amount that they're doing, 285 million in revenue, that's impressive.
285 million in revenue, and they expect that to hit 500 million by 2024. So doubling that over the next couple of years. I feel like it's not surprising. It's big money for what they do, but they just are. It's a marketing machine.
Do you remember 10 years ago when people would speak about startups that were unicorns, and it was like Airbnb and Uber were the unicorns, and everyone was like, "Oh my god, these startups are worth $1 billion." Now we have below the belt grooming startups that are worth $1 billion.
Yeah, times have changed.
Times have changed.
Yeah, you're right. It's hitting it. They're trying to get $1 billion valuation. So
no, they have $1 billion.
Oh, they got it.
Yeah,
right.
This deal values them at $1 billion.
There you go. $1 billion valuation. Yeah, look, that's the environment we're in at the moment.
For me, I would think of Manscaped, and I would say maybe like a Philips or like one of those big, all body razor companies. A Gillette maybe says this is a product extension. They build a good brand. Let's acquire them. I just think about the opportunity of buying Alphabet or buying Manscaped on the market, and I'm just like, what's the growth
Yeah,
story?
it's certainly not a company.
How many? I know you are really a big manscaper, and you've got like your creams and your gels and your different razors, but like,
no way.
I don't know. It's just
Look, there's a big tailwind here for Manscaped. The male grooming sector is definitely growing, and it's becoming more and more acceptable for males to groom, not just down below, but everywhere, and there's products galore. But yeah, I'm not buying it.
But you have a Manscaped razor.
No, I don't.
Yeah, you do. You told me off mic. You told me.
No. No Manscaped razor. We did try and they did reach out to do some advertising, but we said no deal. I'd love to know how
should have done the Jay-Z Beyonce deal. You know how they did they did for Uber and they got equity. We should have done it with Manscaped.
Damn it! I know that they do do spend a lot on marketing. I'd love to know how much they do spend. But yeah, SPAC deals continue. Just an interesting one that's come across our desk.
It honestly is really impressive execution. Like I don't really know the founding team. I think I've seen the CEO's name, but I haven't looked into them at all. But if you think about the amount of founding teams out there and the amount of teams that could have got like a Manscaped razor to $1 billion valuation in 4.5 years and to an IPO via a SPAC, like that is truly impressive execution.
Marketing, yeah.
Like forget, Stripe or PayPal or Airbnb, these businesses that are just like truly great products. This is an execution story.
Would they hit up every single influencer and podcaster and anyone who has an audience and just went ham on them?
Yeah.
And just the way they even engaged with us around links and tags and this is what you need to do and all of that jazz. Like it was a machine.
Yeah.
A machine.
Yeah.
And they were pretty I would say ruthless on how they wanted their advertising to be executed. So, but that's the thing at the end of the day, like it's the same with funds management, all these things. Like you can have the best product, but if you can't market it and you can't talk to consumers and sell the dream, get it in front of them, be aspirational, that's just what it's all about.
Yeah. Now here's the question though, like what's the future for Manscaped? Like the product adjacencies, like women's scapes, I guess.
Female,
yeah, but it's like, I don't know. Or they go big and they go to the face.
They go chest.
Yeah, chest, not bad. They keep inventing new. Yeah, that's not bad actually. Chest isn't bad.
I don't know.
Backscaped.
Bumscaped.
Or maybe they move. Yeah, it's just.
It is what it is. We'll see how it plays out. I have no idea. But it's pretty fascinating that they've got this far. But anyway, Ren, that does bring us to the end of our episode today. A reminder, please submit your nominations for the Equity Mates Awards. Stay tuned because we've got a massive summer series coming up later this month. Later in December. We're really getting towards the tail end of the year. We've got some big episodes coming over the next few months. We've got the the chairman of the Swans, Andrew Pridham, coming up. We've got an awesome episode coming up this Thursday with Eleanor Swanson from Firetrail, all about the Sown Hearts and Minds conference and a couple of stocks that are on her watch list in the biotech space. So really enjoyed that. Don't forget to buy your tickets for the Sown Hearts and Minds conference that is this Friday. Charlie Munger will be speaking at 11 a.m. Not often you get the chance to see him talking. And then we're up to bold predictions and stock of the year wrap up, and we'll have Andrew Brown back to wrap up 2021. So only a few weeks left of content before we hit our deep dives on specific stocks over the summer, which we cannot wait for. We've got some amazing CEOs. Plenty going on across the network as well. The CBE boys closing out the year with the big headlines, and You're in Good Company and Get Started Investing are doing an amazing job as well. And don't forget, Talk Money to Me and Crypto Curious. Plenty going on in the Equity Mates media network. So we'll leave it there, and Ren, we'll pick it up next week.
Well, if people lasted through all of Bryce's housekeeping at the end of the episode, there, I've got a little Easter egg for them. Just been looking at some of Manscape's capital raising. So they've raised $23 million in equity funding to get to where they are. Wow. Which, for me, one is impressive that they've turned that into $250 million in revenue. Two, who's investing venture capital into a below-the-belt grooming startup. Then I had a look at who has. Channing Tatum is a big name that's being thrown around. Yeah. Also, Mark Cuban invested $500,000.
He's everywhere.
Yeah, I guess if you got $1 billion, you got to do something with it.
Yeah.
But yeah, two funding rounds, raised $23 million. And
you know the model that they've tried to replicate here is the Dollar Shave Club, I reckon. It's a slightly different model, but they've just gone execute, business, bang.
But the thing is, and maybe we should have looked at the Manscaped business model, but I just shave my own head and I just go to shaver shop and buy a razor and shave it. There's no the beauty of the Dollar Shave Club was there was a subscription and it was ongoing subscription revenue. I'm not paying the shaver shop a monthly subscription for anything. I just pay them once and I'm done. I would assume the business model is the same here.
Yeah, true.
Again, we should have looked, but
we should have.
Anyway, $23 million into $1 billion company. Well done.
Well done.
We'll see how it goes.
We'll leave it there.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.